Okay, we are live. Welcome to our January 6th, 2020 trade alert. And we're betting up on the S&P 500. This is our call for most of 2020 until we believe the bond market's yields will become so attractive that it does break the S&P 500's back. We'll take a more detailed look at that in a moment, but let's review the current trade alert. If you did take our Friday trade, you had a nice profit, could have been bigger, but the headline risk out of Iran was definitely causing some concerns in the market. Futures was down this morning, but starting to pop up. We entered the SPY ETF at 321.64 last Friday, and as of closing out today's trade, was trading at 322.31. The option collar we purchased was a debit of 8 cents. And the current value is 23 cents. So that's our current profit on this trade, closing it out a 82-cent gain on 1,900 shares, or a profit of $1,558. Now looking at the new trade, it's a little less complex than the previous trade. This is just our loose option collar. There's no cherry on top with the long call in today's trade. And it was a simple one to cover us from now through Wednesday. So we're selling the January 8th 325 call, and we're buying the 320 put. Now, if we remember on Friday, we're tracking the growth of the balance sheet of the Federal Reserve to have an idea of just how bullish the stock market may be the upcoming week. And there's a direct correlation to the growth of the Fed's balance sheet and the S&P 500. In fact, the one time the Fed's balance sheet has gone lower in the last 3 months was the only week the S&P 500 traveled lower. So the growth on the balance sheet was modest last Friday, about $10 billion larger, but they've been on track to add around $25 billion a month. So Friday will really be our special Fed day where we examined the H1 release that really details what have they bought, sold, and how are they managing that massive portfolio that is the biggest influence on the stock market. Okay, looking below, we have the rest of our open positions. GDX pulled back a little bit from Friday, still up 67 cents a share. And that's after having financed the very expensive $1.15 in the money put we originally bought going into this position on 12.19. Now remember, gold had been selling off for several months despite the rapid growth of the balance sheet. So we're playing it safe. I also wanted to make life a little easy in December over the holidays for our followers. So we just had a simple long put option. So if we hadn't bought that, we'd be up significantly more. But even with the downside protection, we're still up 67 cents a share. And again, that's a 2-to-1 ratio of GDX to the SPY, just under 10% of our total portfolio. Now, when I do say it's 40%, 10%, 40%, 10% on the SPY, emerging markets, TLT, and GDX, I am rounding to the nearest 10%. So don't get caught up on a few percentage points. What is important is you have the right ratio, 2-to-1 of the SPY against these different assets. Now, emerging markets had a nice gain as of Friday, and they did give that back with the sell-off over the weekend. And again, we bought that juicy put option to protect us from downside risk, making sure this China deal was really going to happen and that China was not going to allow their bad investments to be realized and to let their GDP growth slow down. So we've slowly but surely seen them remove tariffs, increase soybean purchases. They're sending out a team to sign the trade deal. And they're also expanding their money supply and credit. So this is all pointing towards a very bullish stock market going into 2020. TLT, we came out alongside Stanley Druckenmiller, betting that yields will rise in 2020. And I still remain with that same outlook. The carrot that was leading the bond market lower was a combo of China's growth slowing down and at the same time, the US applying pressure to expedite that slowdown. Now that big fear has been removed and the expectation is that yields need to rise. And so this is really the big dynamic we're now focusing on in 2020 is the expansion of debt of the US, how much of that debt is purchased by foreign investors and versus how much is picked up by US primary dealers, mainly JP Morgan. And so if primary dealers are having to purchase this debt, we know that this will quickly be flipped to the Fed. That expands their balance sheet. And that's what's really driving this huge rally in stocks, which is all backwards sounding, but that's the world we live in with these central banks trying to alter the normal path of how these different investments would normally work. Okay, so the TLT, if you're not assigned today, you'll almost certainly be assigned tomorrow. And again, from the previous trading week, we entered this position at 137.13. We sold the 135 call for a credit of 250. So we'll be walking away with 137.50 a share, which is a 37-cent profit on that side of the trade. Now, I did forget to subtract that from the dollar loss. So we're actually not down $1 on this position. What will be left over with is our long put. So this is what we call the potential for a double payday when we're betting down on an asset. We actually would love for the trade to go against us early in the week, get assigned. This means we're going to sell our shares and as well as close our short call and end up just long the put option, which is the overall direction we believe this market's headed. So we're now long our put option and most likely in cash either today or tomorrow because that call option did double in value. If we scroll down a little more, we have our total return. We started mid-December of 2018. So far, we've delivered a 16.41% return, and the largest total loss in a month is negative 1%. So when you compare the risk to the reward, that's really what attracts investors to our strategy. And now we're plugging away on 2020. To remind us of our trading plan, we trade the SPY Monday, Wednesday, Friday, emerging markets on Tuesday, and then TLT GDX on Thursday. And I have updated our charts so you can see how well we've done in all sorts of market environments. Now, I'd like to say we do well in a flat market, but the S&P 500 is so levered up right now. There's no such thing as a flat market. This thing is just flying up and down, not a lot of sideways trading. And here is November, December. I do want to note that even when we were incorrect, so we were incorrect in predicting that the US-China trade deal had a high probability of escalating going into this phase one trade deal, even though I was wrong and played it safe, like most of the top hedge funds, we did not lose a penny by being on the wrong side of that TLT trade. Now, had we been correct, we'd be showing some very, very handsome returns in November and December. So I look back those 2 months and we see the S&P 500 rose 8%. We pulled a 1.4% return and I wouldn't change anything about it. I really think they were a split second away from not signing that trade deal and really putting the pressure on Trump. Next part of the trailer is how to close out your previous position. So again, we had the three-legged option collar. The bottom leg we call the cherry on top. I did leave that out today. Volatility spiked a little bit. So the cost to buy a long call option is not as good of a deal as it is normally. So rather than take on that trade, I decided to just do a normal option collar. And so if we look at our risk graph, let's pull up the live risk graph. We can see our maximum gain or loss is right there at $2.50 on either direction, or $250 a contract. So we can make or lose around 0.66% on 40% of our portfolio between now and Wednesday. So that's the best and worst case on this part of our portfolio. And Scotty, thanks for the congratulations. It's been a fun year and we're really starting to hone in on how to provide this service to you guys and make it super easy to follow. So I appreciate that comment. Okay, so that is a wrap of the current trade alert. Now, what I want to do next is do a quick Q&A before I play all the news, charts, and data I've collected that will really show you our strategy. We're up to 18 people live. Go ahead and unmute it for all and see if we have any questions or comments. And Ed Danzo, welcome. I do recall seeing an email from you over the weekend. Thanks for joining us live. Murray, how's it going? We got a lot of people.
Pretty good, pretty good.
Oh, Murray, you got your audio. Yeah. So how's it going? What do you think about the, you think we're going into World War III with Iran, or you think this is going to fizzle out?
I think it'll fizzle out unless they do something very drastic, which you never know.
Yeah, they'd have to be pretty crazy, huh?
They would. They are.
They are crazy. Yeah. Oh, man. Well, I've got some good clips from Iran that we'll see in a moment. So I really excited about this huge improvement we've made to my ability to provide good. I know Murray, perhaps he likes the trades, but I think he likes the news and articles I collect every day even more. So if you like what we've been putting together so far in 2019, what I have set up now in 2020 is really much more advanced and detailed. That's exactly where the market is going to pivot towards. I think this melt off. Okay, I'm going to go ahead and mute everyone. I don't think anyone has a question. Pretty simple trade. We have a pretty rock solid prediction for what's going to happen going into 2020. It takes something significant to change my outlook here. Okay, so unless there's a question, I will start I think we got about a 20-minute video clip. Now, this was recorded on an iPad, so I'm getting up around 5:30 Mountain Standard Time. We start off by looking at Bloomberg, then go to Twitter, then we look at some alternative media sources. Then we started looking at treasury auction schedules, and then into different balance sheets of key trading partners with the United States. Now, there's going to be a different set of countries I'm going to focus on each day of the week. So Monday will be dedicated to really our most important trading partners, looking at Mexico, Canada, and then we're also looking at Brazil. Tomorrow will be focusing on China and its key trading partners. Wednesday, we'll be looking at Japan. And then Thursday will be completely focused on the bond market. Friday, we'll close up Thursday at 2:30. Remember, that's when the Fed updates its balance sheet. So Friday will be really focused on that, as well as Europe and the United Kingdom. Okay, so this is my first time trying this. I will have an improved audio come Thursday. So I'm gonna go ahead and play this and make sure the audio makes it to you guys. Okay, so let's see, Ryan should be listening to make sure the audio does work for me. We're up to 20 people live. Thank you guys for joining us. If you did join in late, you can go back to your email in about an hour and replay all of this content by clicking on the same video that brought you to this live presentation. All right. See, Ryan, do I have you on Telegram to confirm the audio for me when I hit play here? Okay, good. All right, guys, here we go. All right, guys, welcome to your morning briefing on the news this morning on CNBC, Fox Business, and CNN. Key topic is Iran. So this is the biggest headline risk this week would be for Iran to retaliate. So far, it's just threats. Trump has pointed out 52 targets, and they have 31 targets. We'll see what happens. For now, I do think this is noise that we can ignore, but I'm carefully watching. This has sent stocks down slightly overnight across the globe, and oil and gold are up. If we scroll a little bit more into our newsletter from Bloomberg, that was the first headline. The second headline is back to China. China is expected to come out January 5th with Premier Liu He to sign the trade deal, which is one of the key risks. Here to stay, this is interesting. A interview with John Williams says he sees the neutral level of interest rates right now at 1.75 staying the same for the next 5 to 10 years. And one bit of possible good news from Denmark, the country with the longest negative rate policy, is that the fear below zero rates are propping up zombie firms is unfounded. What a joke. Clearly, there's a lot of zombie firms being supported by free money. Here's an interesting chart from their update, and you can see some sort of trend line they've pulled from the last 40 years, pointing to an S&P 500 going above 4,000 in the next several years, and that we're trading below trend, which is comical. But I do agree we have at least a 10 to 20% rise so long as Feds are increasing their balance sheet. The next newsletter I like to read is Terms of Trade from Bloomberg. And like I've been mentioning, it does look like the focus will move away from China and over to Europe. A few highlights on issues with France, although nothing big yet. And they include a chart where you can see which states have had the most damage from retaliatory tariffs, although I do think this will reverse course this year, now that we do seem to have a trade deal with China. Nothing big new here except for the expectation for the U.S.-China trade deal to be signed, and we have a lot of trade balance data coming up, although it's quite clear that the next big target will be trying to get a more balanced trade deal out of Europe. In Bloomberg politics, we have World War III and Iran war hashtags trending in Twitter. I think this is unlikely. However, Iraq voted to get U.S. troops out of Iraq completely, and Trump says he'll only do that after they've paid us back billions for the air bases. Meanwhile, not a lot of news on Hong Kong. A little bit of news of Biden having some improvements, some more protests in France. Australia's fire continues to grow. A little bit of news out of Japan relative to the escape artist who's now in Lebanon. China has replaced its top official in Hong Kong, appointing a trusted party stalwart who has promised to bring stability after nearly 7 months of violent protests, in a move that could herald the beginning of a more hardline policy. And again, remember, this is one of the key currencies we're watching, is the Hong Kong peg. If there was a decline in property value from a crashing GDP from too much protesting for too long, that could create a bank run, and they are short by at least $1 trillion relative to how many Hong Kong dollars they've printed. Have you ever seen such a sea of humanity in your life? Real Donald Trump? Do you still want to listen to the clowns advising you on our region? And do you still imagine you can break the will of this great nation and its people in the malign U.S. prison in West Asia? And here's some photos of the protests from the killing of our General Soleimani. The surge in gold prices to their highest in more than 6 years on rising tensions in the Middle East has brought it within striking distance of its most overbought level in 2 decades. And most likely this trend will continue into 2020, so long as we keep interest rates low and expand balance sheets. Now, if you know what I've been predicting, it's modest growth for gold in 2020 and extreme growth in 2021 and 22, trying to predict when the next crisis will roll out and when the Fed will be forced to drop rates lower. New York Fed accepts $76 billion in bids on the repo, a big jump from the $51 billion on Friday. And here's some predictions from the big banks, anywhere from a 3,500 S&P 500 to as low as 3,000, from Morgan Stanley to Oppenheimer Funds. And again, my expectation is a sharp rally in the first two quarters from bond flows, getting out of low-yielding sovereign debt, and rising yields eventually crashing the market towards Q3, Q4. So really focus on that 10-year yield to see when we think the market incline will slow down and eventually cause itself to have a reversal. These media posts will serve as notification to the United States Congress that should Iran strike any U.S. person or target, the United States will quickly and fully strike back, and perhaps in disproportionate manner. Such legal notice is not required, but is given nevertheless. So he was criticized for not telling them about the latest attack. In fact, everything he's done in the Middle East has been criticized, so he's giving them notice. Trump says U.S. will not leave Iraq unless the country repays billions for airbase. And Iranian state TV announces $80 million bounty for President Trump's head. Probably need to add a couple zeros to achieve that one. Here's a look at our Apple News app, which gives us access to a whole bunch of different news sites, magazines, all in one feed. Looking at politics, same headlines that we've seen really across the board. Critique over the Soleimani attack from CNN. And some notes that perhaps Iran doesn't want a war either, which is leading me to think this is all headline noise that we can ignore, and that there's not going to be a retaliation in the near term to change our trading strategy. Now I'm looking at some of the alternative media, Drudge. So we've got some troops going out to the Middle East, I believe about 4,000. A little joke on TV about the Epstein didn't kill himself. Ricky tells Hollywood to F off, torches the elites, know nothing of real world, hit them where it hurts, get drunk, take your drugs, kill me. Here's the zero hedge headlines. Rabobank, World War III, the U.S. has crossed a red line, but it's not the one they think. Pelosi House to introduce war power resolution to limit Trump and Iran. Fake news, 60 Minutes shreds Epstein's suicide theory. It's continuing to not die down. There was that same chart we looked at earlier, what the experts see coming in 2020. And note that none of them see the same thing. There's a look at the new Hong Kong official, who is the strongman and signal to protesters. Okay, now what I have up is the Treasury Direct. This is the upcoming auctions. And again, we just want to keep track of how much debt is being unloaded into the Treasury market. And then also watch these auctions to see how much foreign investment is purchasing it versus primary dealers. If the primary dealers are purchasing it, then they're going to flip it right to the Fed. That's going to increase their balance sheet. And that's directly creating this big move up in stocks. Now we can note that the current not QE is purchasing the bills, which is keeping those rates low, and we have $78 billion worth of debt coming in that's less than a year old, or a year of duration. In the notes and the bonds, that's going to play an impact on our TLT position. So we'd like to see more and more of that being sold into the markets to create downward pressure on the TLT or upward pressure on yields. So not a whole lot coming on the bonds, a good bit hitting the notes with 60 $2 billion, but the most hitting on the front end. Okay, now Hey guys, I'm just giving the webinar a little time to catch up with all this data that's flowing out of it. I've been getting some notes that it's getting a little blurry, so we'll give it a second to catch up. Any questions so far? And we do have 20 people live, so thanks for joining us. The next thing I want to take a look at are some of the U.S. key trading partners. In this case, it'll be Mexico, Canada, Brazil. We'll be studying different trading partners each day of the week. But here's a look at Mexico's central bank, and you can see they are dramatically growing their balance sheet, so that's very bullish. Next, we'll look at Canada's. Canada's been tight with monetary policy rates, and they've been slow to increase their balance sheet, so that's certainly not the direction we'd like to see, although the Fed is making up for the difference, and a similar situation in Brazil, where they have been keeping their balance sheet relatively flat. Okay, now we're looking at the futures market heading into the open. 7 minutes till stock market officially opens. And a little bit of a sell-off, but not a whole lot. We do look at the 3-day futures chart. We can see there's been a bit of a sell-off from as high as 326 on the SPY just a few days ago to 322. But again, the overwhelming picture is extremely bullish. And especially with the Fed expanding its balance sheet. Now on Friday, they only expanded it modestly compared to previous. So we're keeping that in mind with today's trade alert. Remember, next Friday, we'll get the next balance sheet update every Thursday at 4:30. But again, we're still seeing a lot of resilience in the stocks going into the open. Okay guys, here we are at the open looking at our core positions. SPY is down, emerging markets is down, TLT is rocketing higher, and GDX is rocketing higher even faster. Now to reiterate, we're long the SPY emerging markets in gold, and we're short the TLT. And so if we look at the open, we can get a feel for how this is performing. We're seeing a good bounce so far in the SPY. And we'll come back to this before the trade alert, but we're just seeing how this interacts with the open right now. And again, this is an extremely bullish chart on the SPY. TLT, if we do zoom out, we can see a little bit of a bounce. Without some sort of retaliation from Iran, I will be right back to shorting the bond market on Thursday. We may be assigned on the TLT, which is great. That means we get to sell our shares for a guaranteed profit on the long side of the trade, and then we'll be wide open on a put option going into next Thursday. So if you are assigned, don't rebuy the TLT, just sit in cash with the bulk of your position. You'll still be long your put, and that's exactly what we like to see in this situation. Now in this chart, we're comparing the S&P 500 against Canada, Brazil, and Mexico, just to get a feel for how these related countries are performing in the stock market. And so we can see that Brazil is outperforming the US stock market dramatically so far, and it's sort of like a hyperbolic version of the US. You can also note, especially if we zoom in right here, that when the Brazilian stock market starts to sell off, it has been a good leading indicator that there's trouble ahead for the US. And so we can see its path can be somewhat of a predictor for us and an early warning sign. Now it's selling off the hardest this morning, but again, it's the smaller market cap. As far as Mexico and Canada, it's lagging behind the US, but still pointing in the same direction. That's really all I'm doing for this health check to make sure that our trading partners are doing well. Let's see how we're looking on the open comparing these. So we can see that, again, the Brazilian stock market selling off the worst, and the less affected markets, Canada and Mexico, the least. On the TLT, my expectation is we're going to tank into early 2020 towards 120. I think that'll be what breaks the stock market's back as yields become too attractive and banks start to figure out that this will cause a stock sell-off, and also give the ammunition for the Fed to start cutting rates into the end of 2020 and into 2021. And if that's the case, they want to load up on high-yielding bonds and then be able to flip the bonds for a big profit as rates drive yields lower and bond valuations higher. So I do think this is noise that we can ignore. If we look at gold, a lot of people are worried we might be getting towards a short-term top, that it's not going to have a big push because of low inflation, as well as no big headline fear like the US-China. My expectation is, again, that this is not the case, that we'll have modest growth in gold through 2020 and then start to see the real fireworks as the central banks are forced into lower interest rates and real QE. We'll cover that in more detail on Thursday. But we can see just in the last time we had a fiasco like this, the end of 2008 and into 2009, GDX rallied to 64. And I think we can go much higher than that. Not by 2020, but probably by 2022, I think we'll be breaking that top. If we do look at emerging markets, my expectation is for this to break beyond 52 as long as China's playing nice and does continue to expand their currency and their debt levels. So we'll be focusing in on that tomorrow. Okay, so here's my Monday watch list. We've already looked at the SPY ETF. We've got EWW, the Mexican ETF, EWC, the Canadian ETF. They're doing well. Brazil's outperforming and providing a good leading indicator. So the next thing we really need to make sure is intact for our trade alert today is that the U.S. bond market, corporate bond market, is in healthy shape. So to do that, we're going to look at the three largest ETFs that do drive money into the corporate buyback scheme. So AGG is just a general bond fund, the largest by far, and it's still at very high prices. That means corporations can borrow for super cheap. More important, though, I would argue, is this LQD ETF. This is really what's fueling Apple and Microsoft, which are responsible for 20% of the gains in the S&P 500 this year. Microsoft was actually getting negative yielding debt in Europe, so they're getting paid to buy back their own stock, and this is at all-time highs, folks. So this buyback scheme is not going away anytime soon. Maybe the junk bond HYG ETF will crash first, but it's showing signs of strength even. Now the bigger picture does look weak. It looks like this is continuing to roll over, not getting anywhere near that 2014, 2013 high. Just pausing for a moment to let the stream catch up, guys. And we have just a few more minutes of my recorded video here, and then we'll be back to live. And again, it does show the polarity where the top corporations get unfair advantages and gobble up all their competitors, a world of globalization. And so this represents your Russell 2000. It's hard to get a long-term stock rally if only two companies are growing. So it is positive for our thesis to be bullish on equities this year if the HYG chart remains at a healthy level. So this will be critical to continue watching as it is showing a little more weakness. Okay, last but not least, we'll take a look at the dollar. This is DXY and dollar index. And a weak dollar means positivity for world stocks and even US stocks, strong for gold. And again, that is what we want to see. Now, if the dollar is going the opposite direction, that's usually very bad for emerging markets. and causes a lot of problems for them to pay their debt. So this is good. This will strengthen U.S. exports and overall is a good sign. Now let's look at it compared to some specific currencies. What we have here is the dollar index compared to a bunch of different pairs against the dollar. And the big trend over the last, really over the last decade has been a major devaluation of other currencies, especially the Mexican peso losing 95%. But just about every currency under the sun has lost value against the dollar in the past decade. And we're starting to see that trend reverse. So if we look over the past decade, all of these other currency pairs are weakening against the dollar, which is very bad for emerging markets. And now we're starting to see the opposite. We're seeing the trend to go the exact opposite direction. So this will really help with our plays on a bullish stock market, not just in the US, but also in emerging markets, which is critical to remain long equities for a foreseeable future. Okay, guys, so this will be the last clip of the pre-recorded content and what was going into the thought process all morning to make sure we still are firm on our 2020 outlook, which again, the big headline risk is staying on top of the amount of debt the U.S. is printing versus how much foreign investors are picking up, and in turn causing the Fed to increase its balance sheet. And you can see just how strong the stock market is, just rallying extremely aggressively this morning. So that will be our pick tomorrow. Remember, we'll be doing the emerging markets. So just to take a look at what we have coming up on Tuesday on our watch list, we'll be looking at emerging markets, China, Germany, South Korea. We'll be looking at the biggest bond funds fueling those stock markets. And we'll be looking at some different currency pairs, as well as some different central bank balance sheets and money supply growth for China. So thank you so much for listening in, and we'll be back to the live content now. All right, guys. Okay, great. So we're back live. Let's see if we have any questions from the audience now. I'll go ahead and unmute all. Oh, we got a lot of audio. I'll go ahead and.
I know. What's up, that little guy?
Okay, great. So if you do have a question, please let me know by either raising your hand or using the chat box. Okay, great. Let me go ahead and unmute Scotty. Okay,
Hey,
Scotty, great.
Hey, Jason, really good content there. I think any of the visual piece of it we'll get used to, but I do have a specific question.
Sure.
You know, I love to use your service for personal life decisions too, around 401k or anything, but I'm a potential home buyer, okay? And if I understand your position on the TLT, it's that we're going to see some rising rates, and until the bonds related to it fall to the 120 level, and that will force the Fed's hands into rate reduction. So I kind of interpret that as a little bit of a whipsaw in rates. And do you think there's enough there that it will impact mortgage rates? And what would the timing be there?
Sure, great question. Yeah, let me pull up a chart. So the timing on this can be very hard to really, let me just pull this up. So if we do look at some of the crashes in the TLT in the past, you can see these crashes are quite vicious. Some of them are lasting 3 months. Some of them are lasting 1.5 years. So my expectation is Trump's going to be very careful about creating any kind of turmoil going into the election. So this should sell off quite viciously. Now, of course, we got a few wild cards with Iran. I think China is going to back off. So yeah, that's exactly what I expect. Now, how that relates to mortgage rates is not in my specialty for trying to pick up the best mortgage rate, but I would suspect that by the end of 2020, we're going to begin a series of rate cuts into 2021 and re-engage into full-blown trade wars. So I think you're going to see your lowest rates in just in general after 2020 and into 2021.
Okay, great. Plenty of time.
And so they could, so let's say the yields rise and eventually starts to cause a sell-off. I could see them cutting Q4 2020, Q2 2021, maybe even Q2 2021. So maybe 3 rate cuts ahead at the very, very end of 2020 and going into 2021. So if you did want to try to get a lower interest rate, probably right now is a good time to jump on it, or wait for at least a year, maybe a year and a half.
Mm-hmm. Good. That timing works.
Okay, good.
Yeah. Thank you.
Sure. But Karen says housing prices may go up, so be careful. Yeah. Really what you want to do is wait till they hike rates and have enough cash to buy it outright. And then you'll have a fire sale. But that could be many years from here when they actually start to hike rates. Maybe 3 to 5 years out.
Yeah, I've given up on, the recession fears that the media likes to portray as my buying opportunity.
So if you could just get a low rate and a house to enjoy, you'll be a happy camper.
Exactly.
Yeah, fair enough. All right, guys, let's see if we have any other questions out there. Anybody else want to raise their hand or speak? Oh, let me get Dean back. Oh, wait, let's see. Okay.
Hey, Jason, how's it going?
Going good.
Okay, so I was going through a couple questions that came in live there and worked through them. But one from Mark that just came in, he said, question, why buy the nearest dated put instead of farther out? It seems that the put is used for insurance and we buy it back at the end of it not used. So buying a further out put, such as 3 to 4 weeks, would incur less time decay theta over the holding period versus the nearest dated put, while not significantly increasing the delta for a net better selling price at the end.
Sure. So Mark, if you do look at these 2 trades I have highlighted, maybe that's where you got the idea. Maybe you already had it on your own, but certainly you can save money by buying longer duration puts if the asset is going to not really take off. Now, if you do that, here's the catch. You save some money on downside protection, but as your asset rose, that protection becomes worthless. So it does come at the expense that if you're correct with your trade prediction, now that downside protection is not providing the value. So in general, I would prefer to sell a short-term call to finance my downside put. And that way I can follow the price of the underlying asset and keep my put nice and snug. And that will allow me to lock in profits if I'm correct. So that's the bottom line is if we do purchase a longer duration put, you will certainly save money for that insurance for that period of time. But if you're correct with your prediction and that asset significantly rises, all of a sudden your put option's not providing value for you and you're kind of hanging on to these profits by a thin string, I guess. So does that make sense? The pros and cons of doing a short-term put versus a longer duration put? So certainly if I think, for example, GDX, emerging markets, we put this position on mid-December, and we didn't know if the trade deal is going to really be created or not, and if they'd really follow through. Gold had been selling off for 3 months, despite everything happening the right direction for gold, plenty of fear in the market, increase in balance sheet by the Fed at fastest pace in history, but it wasn't going the right direction. Also, there was a period of time where we didn't want to work so much. So from time to time, I will try to save a little money on the put option. But you can see I'm more inclined to do that strategy on the smaller allocations of our capital. So 10% gold, 10% in emerging markets. Because number one, if I do have to experience a sell-off after realizing a gain on those assets, then I'm not leaving so much of my portfolio exposed. And so I'll be much more inclined to use what you just kind of summarized very well on our smaller positions, especially when we're in a period where I want to give you guys a little less work. But in general, if we do want to be able to lock in gains and make our put options really serve their purpose, we do need to move that put option strike higher and higher as the asset rises. So that's the only downside in trying to do that. So if we're correct, we're overpaying for our puts. And so these two are a great example of where we would have made a lot more money had we not bought the longer duration and had just sold an out of the money call on a shorter time horizon and just kept rolling that position over and over again. So great question. And just like anything with finance, there's never a magic yes or no. It all comes with pros and cons. And so certainly, that's a great point. Now, did anyone get assigned on the TLT this morning? If anyone is assigned today or tomorrow, just let us know. It's good just to know from our point of view. It won't change the outcome of the trade unless the only way that you could end up with a little extra profit is, again, if you are assigned, go to cash, you've realized the 37-cent per share profit. Now, again, I had a question on email. A lot of people are saying, well, I bought the TLT months ago at a higher price. So if I get out at 137.50, that's the strike plus the premium we collected. Well, that's not a profit. But remember, we're only tracking from the previous trading period to the current trading period. So we can see our profit loss week over week. So currently we're betting down on the TLT. So if you are assigned and into cash, and then the TLT did significantly sell off into next week, you could actually make a little extra money than just being able to hold the positions and start earning some profit on that $250 call option we sold. Let's see, I think we have another question. Scott still has his question mark up. Any other questions out there, guys? So tomorrow we'll be doing emerging markets and we'll be closing out that January 10th put and be doing the very loose option caller. All right, guys. Well, thank you so much for your time today. Did you have anything else you wanted to go over, Dean?
No. Any other questions out there? And I just was interacting with one of our clients here, and they were basically seeing if they could just do the options by themselves, but definitely want to let you all know that we don't recommend that. It's going to put you in a scenario that's a little too risky. So if for some reason you don't have the capital available to follow the system, just put it in a paper trading account and utilize the theoretical buy of 100 shares of SPY and then wrap the option protection around it as well. Okay. But yeah, not a good idea to just use the options too. We're basically just using those for protection. So definitely follow the full system. And if you don't have the capital to do it right now, just put it in a paper trading account so that way you can monitor in real time.
Yeah, and also if you are starting off with a smaller portfolio, you could consider just following the emerging markets trades or just following the GDX trades. And I think those two will be probably our top returning asset class of 2020 in both directions. So we're playing these in multi directions. So certainly if you don't have the capital to follow the SPY trade, that's 30,000 bucks per 100 shares right off the bat. Then you could start off by just following emerging markets or GDX. So that'll get your upfront cost significantly lower and get you through all the motion of following the program. And if I were trying to outperform the markets, well, you can just go look. That's where our biggest returns are, is in the metals portfolio, as well as the, so you can see we have a 38% total return in the, oh, let's see, I'd have to pull that up. I don't have the breakdown, but yeah, our emerging markets and gold portfolio, again, it is designed to take on more risk and go for a much larger return. So if you're looking to start off with less capital and don't mind a little more volatility, perhaps a lot more volatility, then you might consider that as another option to just get started. And then as you come up with your savings, move around some capital, you can start building into the other positions. Now on Friday, we do some trades that do not require as much capital in our boot camp. So that's another thing to consider, that we have sometimes some just call and put options on Fridays. Also, we currently have a 5% position in 4 stocks that we intend to hold for most likely at least a year. And that way we get that lower tax rate. Now it could be a multi-year hold with maybe some put options to help reduce volatility, but I do intend to help our investors hold on to that position for over a year to get the lower tax rate on those. Well, thanks for the compliment, Hector. We really appreciate it. Yeah, and just the only way you could get something similar to this trade without buying the underlying asset would be to remodel it into selling puts. And you won't have the same risk profile, and it won't be as profitable if we're right with the market going up. And it also encounters the potential for you to be assigned, and instead of being in cash, you'll be owning the asset, which is not a problem if you are buying a put below the put you write. So currently I have avoided offering that alternative to be able to follow this. It would also allow people to get way too levered into our positions. So because of that, I've chose not to issue trades where we're making it easy for someone to go pile in with a whole lot of risk and a whole lot of contracts. So just owning the simple asset, taking advantage of selling that call option, and then buying the put is really a beautiful combination. It's very simple. It works. It protects your capital. It allows you to benefit from the appreciation of the underlying asset and still protect from any kind of really terrible outcome where the S&P 500 could sell off. And once you realize how, despite being very bullish in equities, I still expect to see some high levels of volatility just because of how leveraged the financial system is. And the only thing that's keeping this going is the Fed's increasing its balance sheet. So the second that slows down or stops, there could be some very serious volatility. And that's what happens, and why we're able to produce this low volatility return is because when these big episodes do happen, and they don't happen often, probably every 3 to 6 months, we can expect a vicious sell-off, if nothing else than profit taking. And our put options kick in. So our put options kick in and takes that volatility right out and allows us to sidestep a lot of the really risky moments in the stock market. And the same for gold, emerging markets, and bonds. So any last questions out there? Now remember, tomorrow we have a different presentation. We're trading emerging markets. The analysis, charts, balance sheets we'll be looking at will be completely different than today. And again, by having this macro strategy, it allows us not to get zoned in on the wrong things and to see the big picture. So we're not just focusing on what's happening with the US economy, we're really making sure the entire world economy is acting correctly. And by observing these other countries, we get some good heads up for trouble ahead. Scotty, got any last comments? I know your audio's open still.
Hey, Jason. No, good content today.
Okay, great. Yeah. So did the iPad stream come out pretty well for you? Ryan was saying it from time to time, it got a little blurry. That's when I was pausing it.
It came through perfectly for me. So yeah, I didn't have any pauses. It looked good.
Oh, great. Oh, excellent. Cool. Yeah.
Yeah,
I
it
really,
looked good. It looked good. The only thing I couldn't see was when you were pulling up the bond.
the treasury auctions.
Right. Well, just the charts, and I couldn't. You were telling us what you were looking at, but I couldn't see the you know, what the like if it was the LQD or whatever. I couldn't see that.
Oh,
So
the
maybe-
ticker. Okay.
Yeah. I don't
Okay,
know why.
cool. Well, yeah, I noticed that some of the dates on the bottom bar weren't showing up too. So I'll be careful when I make the recording tomorrow. I think if I move the screen around a little slower, that will help as well.
Okay, that was pretty cool though.
Yeah, it's really neat. It allows me to cover a lot of ground really quickly and to deliver it. You know, it's several hours of reading this morning condensed into 20 minutes for you guys. So that's very cool.
Which is good because I was up in the middle of the night watching this Bloomberg stuff, so I saw a lot going on too.
Oh man, Karen's like,
That's
we're
why-
going to World War III. I know it.
Oh, no. You know, nobody even cares about that anymore. I mean, the market's pretty much gone back to neutrals. I mean, it's hilarious. But
yeah, it's just-
no, but of course I wrote in what I'm looking at because I'm getting more information overseas about the whole Carlos thing than I am locally, because obviously that's a big deal for my family. So I have to keep an eye on it.
Oh, I bet. Yeah.
Yeah, it's pretty critical. Knew it was a little over a year ago, but it's pretty well, like I said, I'll find out on Thursday. I think the guy's not going to show up, so we'll find out.
Yeah, I highly doubt it.
My husband's been fixing up the dealership just so that this way the visitation goes well. And I said, yeah, right.
Oh man, that is too funny.
Yeah, I bet you he won't even show. I said, well, you know. And listen, as far as I'm concerned, let him do a big flush, clean it up, and then, you know, do over. The whole slow, drippy thing is pretty lousy. So,
Yeah, that's always better. Rip the Band-Aid right off.
that's what I'm saying. Yeah. Been through too many airline nonsenses. I'm pretty used to this this feeling. So he's not. I am. But that's what I told him. So
Oh,
we'll see what
man.
happens. Yeah. Anyway,
Nice.
it'll be a movie soon. It'll be interesting. We'll see then. But thanks for all this info today. It's really good. I like the format.
Excellent.
Awesome. Yep. And markets just turned green too. So yeah,
Nice.
pretty
So,
much.
so nobody was assigned on that TLT yet, huh?
Nope.
Okay. Well, we'll keep track of it tomorrow. See if they pulled the trigger this morning. If they were smart, they did. Now, don't forget, we do have our Q&A webinar coming up in 50 minutes. I believe we will. There may be a fellow named Rocky coming in who wanted to learn how to fill out a spreadsheet. So I was going to start demoing that. I'm not sure if he'll make it today or not. So that's one. Two, we will review our open stock picks in the bootcamp position. So that should be pretty quick. Other than that, not a whole lot of new content for the Q&A webinar today. Next Tuesday is our next module lesson. And you're going to learn the inside out of this risk graph with about 100 different examples. So it's still the same basic fundamental idea, but we'll look at what happens to these prices as we go into the future, as we invert them, as we pull up the put near the trading price, as we loosen it, tighten it, add the cherry on top, all the things we've been talking about but it's just neat to see it in a moment in time, and then all the different varieties. So that'll be the next big lesson. And I want to thank everyone for joining us. Any last questions before we prepare for the next webinar? And again, if you're pretty well caught up on all the content so far and the trades, I don't have a whole lot of new information for the Q&A webinar, but I will be on there. So
Yeah, and anyone that's new too, please feel free. I know we have a couple of new people in today. Just jump in, type in questions, or unmute your microphone and just ask them live with us. And Lavinius, I did see you did make it in from the email I sent you, so that's awesome. Good to see you in here. Mike, any questions? Ron, Murray, Mark.
No, I'm good. I appreciate it, guys.
Thank you for your time, Ron. Appreciate you jumping in.
all right, well, hey, it was a great crowd today, and we will be back live tomorrow. So thank you everyone for joining. I'll go ahead and close this out. Thank you so much, Dean.
All right. Thank you, Jason. Have a great day, guys. Call me if you have any additional questions, 505-322-7515.
Excellent. Thank you.